11, right? That is international portfolio investment, right? Let me move to that. Right. So if you compare to what we did last week, right? So at the center, we have financial market. Right? On one side, we have firms, right, that use financial market to raise fund. Right? So we talk about that role of financial market, right, from the corporation's perspective. Right? They use the market to raise fund. Today, I want to move to the other side of the market. Basically, I want to look at investor point of view. So they use financial market, right, as an investment opportunity, right? So this market provide investors with investment opportunity. So we would like to learn how investor make investment decision, right? How do they form a portfolio of investment, right? Learning that behavior, right? Learning that behavior will allow us to understand how investors come up with required rate of return. So this is the return demanded by investor, right? In order for them to invest in financial assets issued by the firm, right? Firm is the one that issue financial assets. So from the firm perspective, that required rate of return by investor, right, can be used as the cost of capital. So what the investor demand from their investment, right, should be viewed as the cost of capital, right, from the firm's perspective. So that's the main purpose for this topic, right? We want to understand investors' decision. Right? Once we learn about that decision, we hope that we can understand how investors come up with required rate of return when they make investment decision on financial assets. And knowing this, right, will help us help firm, right, to calculate the cost of capital, which is the topic that follow from this one. What do we use it for? Cost of capital, right? Firms use cost of capital to make investment decision, which is the following topic after the cost of capital, right? So that's the purpose today. Now we know that, right, there are two types of financial assets, right? Debt and equity. And we know that cost of debt and cost of equity are not equal. In the end, right, we have to combine cost of debt and cost of equity, right, into a single number called WACC, right? Now, since we don't have too much time to learn each cost of capital separately, what I will do is that I would like to argue that cost of debt, right, is easier to estimate, right? Because the required rate of return is well specified in the loan contract. And we already learned how to calculate cost of debt, right, in the previous topic. Therefore, in this topic, right, this current topic, I would like to focus only on equity investment, right? I want to focus on equity investment, right? And the end result, right, is that we should get some idea on how to calculate the cost of equity, right? A lot of the things that I will cover today, right, I understand that you have learned, right, many of the concepts that I want to talk today in your previous subjects, right? So therefore, right, in many calculations, right, I will not go into the details, right? I just understand that you have learned some of these calculations in the past, right? Okay. So what I do, right, in this topic, right, I just expand the scope, right, from in the past, right, you might have learned, right, how investor form investment portfolio, right, assuming that they only invest within their own country, right. In this topic, right, we want to expand the scope of investment, right, to include foreign securities. Okay, so basically just expand the scope of what you have done in the past. So we want to learn how equity investor, right, can invest, right, in international stock, right, in this case. Now, what I want to do first, right, I would like to give you a review, right, of this concept, right, the portfolio diversification, right, and after that, then we go into international portfolio diversification, right? Okay, let's start with the concept of diversification. When investor, right, would like to invest in a stock, right, what investor use, right, to make decision is that the investor, right, have to estimate, right, the expected return and the risk of the investment first, right? After estimating expected return and risk of an investment, then investor can make, right, whether to invest or not to invest, right, decision. So the first step is that we should understand the concept of risk and return first on a single asset. And after we understand the concept of risk and return on single asset, then we will see how that might change, right, when investor form a portfolio that consists of many assets, right? Okay, let's start with a concept of risk and return, right? When investor would like to invest in financial assets, right? Right, the two most important properties of financial assets that will affect the decision by investor is the expected return, right, and risk of the asset. Okay, you have to keep in mind that I am talking about expected return because at the time of making investment decision, investor doesn't know the actual return for sure. So they have to come up with some kind of forecast, right? And that forecast is the expected return. And they also understand that the actual return might not be the same as what they expect, and that is called risk. So they have to consider these two properties of investment in order to make the decision, right? Now, expected return, right? This is how we calculate expected return. So basically, investors have to forecast future price first, and then forecast, right, future periodic income from the investment. So if this is stock, right, investors have to predict stock price at the end of the investment period, predict dividend, right? Then subtract current price divided by current price. That is expected return. As for risk, risk is the chance that the return could be deviate from that expectation, right? Now, after calculating expected return, and you can see that the expected return is calculated from current price and forecasted price. So after having that expected return, right, the investor have to compare that expected return with the return that he wants. The return that he wants, right, is called required rate of return. Okay, if the expected return is higher, right, that implies the stock is quite cheap, and therefore investor should invest. You might have to change the sign in your lecture note. I think that there's typing error in your lecture note, right? But if the expected return is lower than what the investor would like to have, then the investor will choose not to invest, right? The price too high. Okay, let me show you how this concept works. Okay, using this example, right? An investor is considering, right, whether to buy a stock called AAA. Okay, the current price, this is the current price, 100 baht. That's the current price, which is observable. That is the market price today. Now, he would like to invest for 3 months, and he forecasts that at the end of 3 months, right, the price will be 104. Normally, it is security analyst, right, who will come up with this forecast, right, for investor. So you can look at 104 as the number from analyst forecast, right, analyst consensus, things like that. So that's the expected price at the end, right, of the 3 months. Now, the investor also, right, believe that the stock will pay the dividend of 2 baht per share. So that would be the expected dividend. So from this input, right, we can calculate expected return on this stock, which is 6% per 3 months. And this is the expected return that is implied, right, in the current price of the stock. Basically, if we can buy this stock at 100 baht today, we expect to earn 6% return in 3 months' time. So this is the expected return implied in the stock price today. Now, whether that expected return is high enough to induce investor to invest, right? Investor have to compare that expected return with the minimum return that he wants. And the minimum returns that investor would like to have from the investment is called required rate of return. So how do you think investor come up with this number? How investor come up with the required rate of return? Right? In the past, you have learned theories like the CAPM, right? The APT. Basically, CAPM and APT, right, try to explain how investors come up with the required rate of return. So in general, right, finance theory say that required rate of return should consist of 2 parts. Risk-free rate, right, and that is from the yield on government bond, right, risk-free rate. However, this is a risky investment. Therefore, a risk-averse investor would also demand a compensation for the risk, right, called risk premium. So that's the general concept in finance, right? And this is how investment risk comes to play, because that risk premium, right, whether the stock is risky or not, the first component will be the same, right? If you compare stock A, B, C, and D, right, required rate of return consists of risk-free plus risk premium. So the first component of the required rate of return should be the same for all stock, right? That is the risk-free rate. So what makes different is the risk premium. Right? So that is the part where risks come into play. So if the investor perceives that this stock is very risky, he would demand more premium, so higher required rate of return. If he thinks the stock is not risky, then required rate of return will be lower due to lower risk premium. Okay, so assume that investor come up with the number that the required rate of return, right, is 5%. So in this case, right, expected return implied in the current price is higher than what the investor demand to compensate for time and to compensate for risk. So that means the stock price is a bit cheap. The stock price today is relatively cheap. and therefore investors should invest. Now, if all investors think the same way, there will be a lot of demand on this stock. So a lot of investors will purchase this stock because the expected return is higher than what they require to compensate for risk. Right? So if all investors think the same way, we should expect the stock price to go up afterward. Right? And as the stock price goes up, expected return will go down. So in equilibrium, we should expect expected return and required rate of return to be the same. And that is in equilibrium. Right? So this is how required rate of return can, in the end, affect stock price today. And the stock price implies the ability of the firm to raise funds, right? Because if investors are willing to pay more for this stock, that means the firm can raise funds easily, implying that the cost of capital starts to become lower, right? So required rate of return imply the willingness, right, of the investor to purchase the firm's stock, and in the end, it will reflect the ability of the firm to raise funds, and therefore the firm's cost of capital. So in finance, right? In finance, whether you use CAPM, whether you use APT theory, right? Basically, the return from those theory reflect required rate of return, and firms will use this required rate of return, right, to reflect the cost of equity capital. Okay, and if the market is in equilibrium, right? If the market is efficient, then the expected return implied in the stock price, right, will be exactly equal to the required rate of return. Or in equilibrium, expected return implied from the current price of the stock and required rate of return demanded by investor. In equilibrium, these two numbers must be equal, right? So in this example, right, if I assume required rate of return of 5%, then the market is not in equilibrium yet. So in that case, right, we would expect a lot of investors would like to purchase this stock because 100 is relatively cheap. So once demand for the stock increase, current price will go up, but it doesn't change the prospect of the firm, right? Therefore, expected price in the future remain at 104. That reflect future prospect of the firm. But the current price go up due to high demand. So as the current price go up, expected returns start to go down. And we should expect everything to stop when the expected return is exactly 5%. Right? Therefore, in equilibrium, expected return and required rate of return will be the same. Okay, right. So that's the concept, right? So today, right, we would like to understand how investors come up with that required rate of return, assuming that investors have the opportunity to invest in foreign stock as well, right? Not only investors can invest, can diversify in domestic securities, right? In this chapter, we want to expand that opportunity to include foreign securities. Okay. Next, right? If I have to calculate expected return this way, I have to forecast the price first. And to forecast stock price, I probably need fundamental analysis, right? Need to know the firm's business, right? Need to forecast the firm's cash flow, right? And then discount into the stock price. That could be quite tedious. So another way to come up with expected return and risk is to use historical stock price movement, right? So rather than forecasting the price, right, and then compare with the current price to get expected return, right? Another way that I can come up with expected return and risk of a stock is to use historical analysis. Basically, use historical stock price, right, and return. So if I want to use the historical method, right, rather than fundamental or scenario method, right? Let's say this is today. Assume that, right, I want to forecast the return of this stock next year. So I want to know, right, what is the expected return, right, between these two points. Today is year 100, right? I want to forecast what happens if I buy the stock now and hold it for one more year, right? So what would be the expected return during this period? Now, rather than try to forecast the stock price at the end of the year, right, to come up with the expected return and risk, another way that I can come up with the expected return is to look backward. So I look back, right, 1 year at a time because I want to forecast 1 year period. So what I collect here, right, is the return of that stock in the past. So each point represents stock return in a particular year. So I just collect historical return of this stock. So I look back for about 70 years period in this case, right? From year 100 to year 26. So the blue curve, that the historical return of this stock. Now, from the historical return, right, if I assume that history will repeat itself, right, I can calculate the mean return and use the mean return to present expected return in the next period. So 13% is the average annual return over the past 70 years, right? And I use that to represent my expectation next year. So that's the calculation, right? Mean historical returns to represent expected return. Risk. So the green line here, right? That green line represents expected return. The blue line represents actual returns. So the gap, right? The gap between the green and the blue line, let's say that point. So the gap here, that gap represents deviation from expectation, right? That gap represents deviation from expectation, and that fits with the definition of risk. Risk is the chance that actual return will deviate from expectation. So if I want to measure risk, I can actually measure the size of that deviation, right? But since I use average return from many observations, so what I do is that I will calculate deviation from the mean from every year, and then take the average, right, of the deviation from the mean. So I have deviation from the mean here, right? That the deviation from the mean, right? And then I take the average. So some deviation divided by number of observations. So that will be average. However, if I do that, right, I always get 0 because the mean is in the middle. So there must be half of the time that return is higher than the mean, and half of the time that the return is lower than the mean. So the average, right, deviation from the mean must be equal to 0. And if I get a measure that is always equal to 0, it doesn't make any meaning. So one way to avoid that result is that after I calculate deviation from the mean, take the square first. And after that, average that square deviation. The average square deviation, right? We use sigma square, right, as the shorthand for that average square deviation. That is called the variance. That is called the variance. The unit of variance is percentage square, right? Because you take square from the return. But the unit of expected return is percentage. So when I put expected return and variance side by side, it's quite hard to get the feeling, right, of how risky this stock is, because they are measured in different scale, right? The mean, right, is in percentage. The variance, right, is percentage square. So what finance people normally do, right, to get better feeling about the size of the risk, is that we will take the square root of the variance to get another measure known as standard deviation. Now you can either use variance or standard deviation to represent risk. It doesn't matter which one. It's just that it's more conventional, right, to use standard deviation due to the fact that the scale is the same as expected return. So that when you put the two side by side, you get better feeling about how risky the stock is compared to using the variance, right? Okay, so in this topic, right, I normally use standard deviation rather than variance, okay, to show you the risk. Okay, move on. That's how we measure expected return and risk of a single stock, right? We know that, right, investor will not invest all his or her wealth in just one security, right? So to reflect more of the reality, right, we should assume that investor normally invest, right, as a portfolio. So in that case, right, we have to know how to calculate expected return of a portfolio and the risk of the portfolio. So this one, right, I show you how to do that, assuming there are two securities. If you want to expand it to 3, 4, 5, right, you use the same concept, but I will not go beyond 2, okay, in terms of calculation. But the concept, I will expand more than 2 assets. If I start with 2 assets, asset 1 and 2, so I put them into a portfolio. So if I want to calculate return of the portfolio, I can simply take the return from each stock. So that the return from stock 1 and 2, then weight the return, right? Weight the return, right, in accordance with the proportion of total investment that we put into each security. So W1 is the weight on stock 1. W2 is for stock 2. So W1 and W2 reflect portfolio weight. And you have to make sure that W1 and 2 that you use must sum to 1, because that reflects total investment. So 100% of the investment, right? W1, W2 must be sum to 1, right, to be qualified as weight. Okay. Now, we know that returns are random. So R1 and R2 are random variables. Weight is a constant term because weight is determined at the onset of the investment. So W1, W2 are constant terms, right? R1 and R2 are random variable. So if I take expectation both sides, right, I can simply use the formula from your basic statistic subject, right? When you have 2 random variable and you sum them up, then you take expectation of that sum. Right? The result is that you can actually separate the expectation into 2 terms and sum them. So expectation of the sum equal to the sum of expectation. And then you can bring constant term outside expectation side. So that's how we get the first one. Now, in terms of risk, so from the first equation, whenever you are not really familiar with this kind of calculation, my suggestion is that always calculate risk as variance, right? And then you take square root at the end. Okay, you will not get confused. But if you start with standard deviation, you might get confused if you are not used to. Okay, so from the first equation, right, I take variance on both sides. I take variance on both sides of the equation. Therefore, on the left, right, on the left, I would have the variance of the return on the portfolio. Right, on the right-hand side, I would have the variance of the sum between two random variables. And in our statistical subject, we know that the variance of the sum of two random variables is equal to the variance of the first variable. So that is the risk of the first stock, right? And the variance of the second random variable, that is the variance of the second stock. Since W is a constant term, we can bring it outside variance, right? So that become W1 square, W2 square. And in variance calculation, apparently the relation between the two stocks play the role in the eventual risk of the sum. So the third term would be, right, the term that reflects the relation between the two stocks. So the last term, right, is 2 multiplied by weight, right? And then multiplied by standard deviation of each stock. Then multiplied by the correlation, right, between the return of the two stocks. Now that last three terms, the product of the last three terms, right, that is actually the covariance between the return of that two stock. Right? Sometimes we write the covariance as sigma ij. So in the variance calculation, right, the last part, right, the product of that three terms, right, you can actually combine them and write them as the covariance. Same thing. When we use covariance, it is quite difficult to say, right, whether the covariance number reflect strong or weak relation, because the covariance number doesn't have bound. When you look at the covariance number, you can only say whether they have positive or negative relation, but you can't talk about the degree of the relation, how strong that relation is. And that's why we normally, right, convert covariance into correlation by dividing the covariance with the product of the two standard deviation. And that correlation has a bound between -1 to +1. So because it has bound, therefore, when you look at correlation, not only you can talk about direction of the relation, you can talk about the strength, right, of the relation as well. Okay, that's why a lot of textbook, right, normally write the last term, right, that covariance term as the product among the three terms, right, with correlation in there. Okay, right. So that's how we calculate risk and return, right, of a portfolio that consists of two stocks. Let's try how to do that calculation, right? Here, I would like to form a portfolio, right, that consists of two stocks, Motorola and GM. Okay, so I need to calculate expected return. Oh, by the way, I forgot to tell you, after you calculate the terms in the bracket here already, right? What you get is the variance. So to go into standard deviation, do not forget to take square root of the variance, okay? Right, so I have two stocks, right? I want to form them into a portfolio. So because of that, right, I would like to know the expected return and the risk of the portfolio. Now, how do I calculate, right? If you go back, okay, in order to calculate risk and return of a portfolio that consists of two stocks, I need many inputs, right, into the calculation. So what I need is the expected return on each stock. I need the standard deviation or the variance of the return on each stock and the covariance between the two stocks as well. Furthermore, I also need to know the weight that I want to put in each stock. So among these inputs, right, among these inputs, there are 7 of them, right, for the calculation. 5 of the inputs are from market. Basically, 5 of these inputs are market information, has nothing to do with investor. 2 of these 7 inputs depends on investor. You can tell me, right, which one depends on investor, which one belongs to the market data. So basically the weight, that is investor decision. But when it comes to expected return, standard deviation, and correlations, these are market information. So we need 2 sets of input, right, from market data and from investor decision. So this table shows you market information on the 2 stocks. So we have expected return, we have standard deviation, and we also have correlation. As for the weight, right, investor would like to put 700 on Motorola, $400 on GM. So total investment is 1,100. The weight on Motorola is 7/11. The weight on GM, that is 4/11. Then what you have to do, just to plug in everything, right, in the formula, right, to get the result, expected return and risk. My suggestion is that when you have to do this kind of calculation, and if you are not used to the kind of calculation, try to do them in decimal points first, right? You can see that I convert everything into decimal point form, right, rather than percentage form, right? Because that will reduce a lot of confusion in the end, right? Okay, I guess the calculation, I can leave it to you, right? Before I move on, please answer this question. When you look at this correlation between the two stocks, what does it mean? Can we say anything about the relation of the return on these two stocks? Looking at the correlation. So the correlation is positive, 0.37, about 0.4. So we can say that the correlation between the return on these two stocks, right, is positive. So basically the return on these two stocks on average. That's right. So on average, they tend to move in the same direction, right? The return on these two stocks on average tend to move in the same direction. But the relation between the two stocks is not that strong, right? Because 0.37, if you compare between 0, which means no relation, and 1, positive 1, which means perfect correlation, you can see that 0.37 is closer to 0 than 1. And therefore, I conclude that even though on average, the return on the two stocks tend to move in the same direction, but that relation is not that strong. So there are many times that they do not go into the same direction, right? That's how you interpret the correlation. Okay. Next, here, right, I form one portfolio using one set of weight. What I want to do next is that I would like to form many portfolios using the same two stock by changing the weight, right? So I employ the same information from the table, but this time I try many weights, right, to see what would be the expected return and risk of different portfolio. Okay, so I start with having 100% on GM. Therefore, the expected return, right, and the risk would be equal to that of GM. And then I start to reduce the weight on GM, right, 25% at a time, and put, right, that into Motorola stock. So I keep doing that until I reach the fifth portfolio where I have everything in Motorola and nothing in GM. So here I have 5 portfolios, right? And then I use the same equations, right, to calculate expected return and standard deviation of the return, right, on each portfolio. What I do next is that I would like to take that 2 columns. I would like to take information from that 2 columns to plot a graph. Okay, so I will plot a graph. Now, the graph that I want to plot, right, I want to use the x-axis to represent risk, which is standard deviation. And I want to use the y-axis to represent expected return. Right, so each row, you have a pair of expected return and standard deviation. So if I take row number 1, right, I would get 1 point. Row number 2, I get another point, and so on. Okay, you understand how I do it, right? So the result of that is here. So once I get each portfolio on this graph, right, this is the graph that represents the plane of standard deviation and expected return, right? After I plot each portfolio on the graph, then I connect each point, right, using a line to connect it. Now, if I want the line that I connect each point, right, to look smoother, what I can do is that rather than changing the weight 25% at a time, I can change the weight 1% at a time, and I would have more portfolio, right? So that when I draw the graph, right, the curve looks smoother, right? But this is the kind of graph we get from that practice. Basically, each point on the graph represent one portfolio that consists of 2 stocks. So another point, that another portfolio, but different weight. So you can think of this curve as the curve that represents investment opportunity for the investor, given that there are just 2 stocks to choose. So this curve looks like a bullet, right? This curve, because you can actually extend further, so it looks like a bullet. So they call this bullet curve. So what the bullet curve, right, show to us is that it shows us investment opportunity that investors have, given that there are just 2 stocks in the market. So if investors want to invest, right, they have to choose one of the points on this curve. They can't invest outside the curve, basically, because this whole curve represents every investment opportunity already. So investors have to choose which point to invest, right? Investors might want to choose that point. That means invest everything in Motorola. On this point, combine GM and Motorola with 25% weight, right, on GM, 75 on Motorola. Right now, From that whole opportunity set, you can also see that, right? If I separate this bullet curve into two halves, the upper and lower half, you can see that when investors choose where to invest, investor will ignore the lower half and only focus on the top half of the curve. That is because, right, if I start with a portfolio on the bottom half, portfolio A, you can see that there is always another portfolio on the top half that have the same risk as the one in the bottom, but better expected return. So in this case, as an investor, when we choose where to invest, we shall ignore that lower half. So the top half of this bullet curve is known as the efficient frontier, right? Efficient frontier or efficient investment set, right? Okay, right. Okay, that's already the top half. Okay, next. From the bullet curve, right, you can also see that as an investor, the shape of this curve, oh, actually, before I go to the shape of the curve, right, let me go back to the table first. Then I come back to talk about the shape. Another thing I want to explain to you is that a lot of people, right, always misunderstand about the meaning of benefit from diversification. Right? When you talk about diversification benefit, people normally talk about risk reduction. But risk reduction is just one aspect of the benefit from diversification. Let me explain to you why I say that a lot of people got this one wrong. Okay, keep in mind that the keyword I want to explain to you is okay, that's for diversification, okay, benefit. Now let's start from portfolio number 5. If I start from port number 5, right, I put everything on Motorola. This is the expected return. And this is the risk of the portfolio. Now, if you go back to the table, you can see that Motorola is a stock that is riskier compared to GM. Right? GM is less risky. So if I start from Motorola 100%, right, then I move my portfolio by reducing the weight on Motorola and increasing the weight on GM. So move from 5 to 4. Of course, I reduce the stock that has higher risk and increase the stock that has lower risk into my portfolio. My portfolio risk must be reduced, right, by this action. However, if you go back to the table, expected return of Motorola is also higher than GM. So once I reduce Motorola weight, increase GM weight, not only I reduce the risk, I also reduce the expected return. Now, we prefer high expected return and low risk, right? But in this case, the movement basically from 5 to 4, Basically, I am trying to diversify my portfolio, right? Moving from 5 to 4, I am trying to diversify my portfolio. And the result of that action is that I reduce risk. So that be good, I reduce risk. But at the same time, I also reduce my expected return. That is not good. So basically, that is the trade-off. That is not benefit, right? If you diversify, you reduce risk. That's benefit. But you also have to sacrifice expected return. So that means you lose something. So basically, reducing risk and expected return altogether, that is not benefit, right? That is just a trade-off. So when people talk about diversification benefit, right? If they talk about risk reduction, right? That is just one aspect, because you have to think about expected return as well. And when you diversify, right? Of course, you have to include both high and low return stock into your portfolio. Expected return will be in the middle, right? So you have to sacrifice some return. So what is the true meaning of diversification benefit? Right? It's not risk reduction, because if you reduce risk with expected return, that is a trade-off. To understand the benefit, right, I guess you should do this calculation. Take the number on the third column, divide by the number in the fifth column. That reflect expected return per unit of risk. You can see that whenever, as a risk averter, you prefer higher number of the last column, right? The last column, right? If you can achieve, you would like the number to be higher, right? Because the higher the number in the last column means we get higher expected return for 1 unit of risk, right? So risk-averse investor would prefer higher number of the last column. Now you can see that, right? Portfolio 1 that contain 1 stock. Portfolio 2, sorry, not 2, portfolio 5 also contain 1 stock. You can see that whenever you have 1 stock in your portfolio, expected return per unit of risk tend to be lower compared to when you combine these 2 stocks into a portfolio. So that's the benefit, right? By diversifying, we can improve return per unit of risk, right? We can improve return per unit of risk, right? Even though as I diversify from 5 to 4, I reduce return. I also reduce risk. But risk reduction tend to be quicker, right? When we diversify portfolio, risk reduction tend to occur quicker than return reduction. And that's why we can improve, right? Return per unit of risk. And that is the meaning of that term. Okay, there are 2 aspects you have to put in together, right? Okay. Now, let's focus on the shape of this graph. This is bullet curve, right? Normally, when we put 2 stocks that don't have perfect correlation, you always get this bullet curve to represent your investment opportunity. Now, if for some reason we can move this curve, right? Since for a given level of risk, we prefer more return. So if for some reason we can move this curve upwards. Furthermore, for the same level of return, we prefer less standard deviation. So if we can move this curve, right, upward or and toward the left hand side, we would get a portfolio that give us even better risk return trade-off. Right? So basically, if we can move that bullet curve toward the upper left hand side, we would get investment opportunity set that is more efficient. That is more efficient than the one before. Therefore, I start to have a question. What is the main factor determining the shape of this bullet curve? right? What is the main factor, right, determining whether this curve should be, say, a straight line, should be even more curvy than this, right? What is the main factor determining the shape? Because that has implication about diversification benefit, right? Now, to answer that question, what I do here is that recall that this curve was produced, right, by assuming 0.37 correlation, right? So what I do next is that I will change the correlation, right? I start from +1, right, and then construct this table, and then construct the curve. Then I go back, right, reduce the correlation, right, to another number, construct the table, and do the curve. Then keep doing this, right, using many correlations. And this is the result. You can see that when the correlation is equal to +1, that's perfect correlation, right? The combination between the two stocks is on a straight line. That means you don't get much benefit from diversification, right? But once correlation starts to become lower, right, you can see that the curve start to move toward the upper left hand side. So that means we get the portfolio is more efficient, right? So that's more benefit from diversification. So now we understand that it is the correlation between the two stocks that determine whether we get a lot of benefit or not much benefit from diversification, right? You can also see that when we can identify two stocks whose correlation is perfectly negative, we can even form a portfolio that is risk-free, zero risk. So it is a correlation, right? Basically, the correlation that dictate, right, the magnitude, right, of the benefit from diversification. Now, on average, right? Oops, I have a question, I guess. Yes, if you can find two securities that has -1 correlation, you can see that you can even combine them into a riskless portfolio and earn positive return. Can you see this? So that means if the market is efficient, right, that point must be equal to the risk-free rate of return. Yes, you get benefit. You get a lot of benefit if you can find that. So the lower the correlation, the more benefit from diversification. Okay, but if you exclude derivative, okay, if you exclude derivatives, I don't think you can find two stocks whose correlation is -1, right? That only can be found, right, from derivative contract, like future contract, things like that. But ignoring, I mean, excluding derivatives, I don't think that there are or there is any pair of security with the two extreme correlation, right? Most stock has correlation between 1 to -1, but not exactly 1 or -1. Okay, that brings me to the next question. If I randomly pick two stocks from the SET, right, the Stock Exchange of Thailand, I randomly pick two stocks from the SET. Do you think the correlation that I will get from the two stocks is positive or negative? Basically, I am asking you the average correlation between a pair of stocks, right, in the same exchange. Are they positive or negative? Okay, think about that first. Oops, oh, there. That's right, they are positive. Why is that the case? Why do you think they are positive? Good, they are positive on average. Of course, there are some pair with negative correlation, but I'm talking about average. On the stock exchange of Thailand, right, we have about 500 stock. So if I have to form them into pairs, right, there would be 500 square minus 500 divided by 2 distinct pair of securities. So that's more than 100,000 pairs of security that I can form. I want to know the average correlation of that more than 100,000 pairs. It is positive. That's right, because stock, right, they are mainly driven by the same macroeconomic factors. If the two stocks are from the same market, right, you know that stock price can be driven by market-wide, right, or economic-wide variable, right, and they are driven by the same economic situation. That's right, you're right, right, Kun Supi Sara, that's right, because they are mainly driven by the same macroeconomic situations, the same macroeconomic policy by the government, right? So on average, correlation is positive. That's right. Moved by that's right. They tend to have positive correlation with the SET index, right? So that means if I draw the bullet curve on average, it should be somewhere here, I guess, right? It should be somewhere here. It's less than, I mean, it's less than 1, but more than 0 on average. Okay, right. Next, okay, the next concept will be quite important. Just now, right, I show you 2 stocks. Okay, let's expand the opportunity to include more than 2 stocks. Let me show you a simple analysis. So I have 3 stocks. A, B, C. Now, if I only consider opportunity from A and B, right, I can just draw a bullet curve between A and B. Whether it is curvy or not curvy depends on the correlation, right? But we know that in general, it's a bullet shape. So that curve represents investment opportunities, right, from A and B. Now I can combine B and C to get another opportunity set. Now I can also combine A and C to get another opportunity set. Now, if I pick up this portfolio, that is a portfolio that consists of B and C. And then I combine that with A. I would get another opportunity set. Actually, I can pick any portfolio from the previous bullet curve and then combine them into another portfolio. So what this one tries to tell you is that once we have more than 2 stocks, right, the investment opportunity set become an area, not just a line. Basically, any portfolio within that shaded area is possible. So once we expand to include more than 2 stocks, right, to invest, the investment opportunity set must be represented by an area, right? Look like Batman wing, right? That area represents investment opportunity set, the whole area. Now, if I am an investor and I have to choose where to invest, taking into account, right, taking into consideration, right, the whole opportunity set, will take me a lot of time to, in the end, because in the end, I just choose one point to invest, right? In the end, right, we just choose one point to invest. So if we have to take the whole set into consideration before we can choose just one point, that decision process will be too tedious. Now, what Markowitz, right, Harry Markowitz, you learned this name before, right, suggests is that rather than concerning all the whole set, investors should concentrate their effort on a subset of that opportunity set. And that subset is called the efficient frontier. How do we identify the efficient frontier? Basically, if I pick one level of risk, say this is 10% SD, you can see that there are so many portfolios here that give us the same risk, but there is one that maximizes expected return, and that one is on the contour. So for a given level of risk, right, we shall only consider portfolio on the contour, because that will be the one that gives us the highest expected return for a given level of risk. And the part of the contour that we are concerned must be the upper half only, not the lower half, okay, because the lower half gives you the minimum expected return. So therefore, after we get the investment opportunity set, before we choose where to invest, right, we should identify the efficient frontier first. And that efficient frontier is the upper half of the contour, right, of that opportunity set. And that contour, right, the upper half of the contour part is known as the efficient frontier. So that blue curve is what I mean. So investor, right, only choose where to invest on the efficient frontier only. They don't have to worry about anything underneath. Okay, so that's something that you learned, right, in the past. Okay, what I want to do after we come, if we have time, right, is that I want to show you how that curve might change, how that efficient frontier might change if we include foreign securities into the part of the opportunity set, right? We talk about that later. So here we still consider only domestic securities, right? We include foreign security in the second half of this topic. Okay, before I go to that second half, right, I have one concept to explain. And this concept will be important later. Let's assume that we want to focus on the risk reduction aspect of diversification. So this experiment, right, this is the result from an experiment, focusing on the risk reduction aspect of diversification. Okay, basically the experiment, right, is done this way. Oops, I need to show you how that curve is constructed. So the x-axis represents number of stock in the portfolio, and the y-axis represents risk level of the portfolio. So basically, if you look at stock on the stock exchange of Thailand, so let's say that is the universe of stock. So the researcher, right, that construct that famous curve, right, what they do is that they want to show, right, what happened to the portfolio risk as we include more and more stock into the portfolio. So basically, they want to study the relation between portfolio risk and the number of security in the portfolio. So they form randomly selected portfolio. I start with a portfolio that has one stock. So basically, you close your eyes, randomly pick one stock in that universe. and that stock you pick will be the representative of a portfolio that consists of one stock. So record the risk or the standard deviation of that stock. And you let's say, right, if that SD of that the stock that you pick is 30%, right? You can scale that 30%, right, to be 100%. So that is 100% of the risk of that portfolio. And after that, we compare portfolio risk with 30% to see whether the risk of the next portfolio would be higher or lower than 30%, by how much. Okay, so scale or normalize, right? Normalize the risk of portfolio with one stock to be 100%, right? And after that, relative the risk to 30%. So next, right, we randomly select two stocks and form portfolio of the two stocks. Then measure the risk of that portfolio. What they found is that as they increase number of stock, right, into the portfolio, risk is reduced. And what interesting is that when they start to have more and more stock in the portfolio, risk reduction is quite quick early on. But after reaching certain level of diversification, right, the risk reduction benefit tend to tail off until we have all stock in the market, in the portfolio. Certain level of risk still remain. And that's the result they find. Okay, let's go back to that graph because I have something to explain. But that's how they get the graph, right? Now, assume that there are 2,000 stock in the market. So this is the portfolio that we include all stock in the market into the portfolio, right? So let me call this port as a fully diversified with ED. So that stands for diversified, right? Portfolio. So that's the portfolio. So you can see that even after we have all stock, right, in the portfolio, certain level of risk still remain. So financial people call this risk, right, call the remaining risk here as market risk. Right, because here you have all risky assets in the market in your portfolio already. You still have certain risks, right, that remain. So that must be risk of the whole market, right, called market risk. Now, from this graph, right, you can see that if I would like to create a portfolio that is well diversified, it doesn't have to be fully. But if I just want to reach a stage of being well diversified, you can see that I don't need to hold 2,000 stock in the market. This is from US market. I don't need to hold 2,000 stock because after I reach, let's say, right, from this graph, after I reach 30 stock, you can see that the risk of a portfolio with 30 stock and the risk of a fully diversified portfolio, they are not much difference. Basically, risk reduction benefit after I move from 30 upwards, that there are not much benefit left, but still some benefit left, right, in terms of risk reduction, but not much benefit left. So if I don't have much money to diversify, right, I don't have to worry because the difference between fully diversified and well diversified in terms of risk reduction is not that much, right? So being well diversified is more achievable than being fully diversified, right? But in practice, if you want to be fully diversified, you can also with limited amount of money, basically buy index fund. Okay, but in the past, right, they don't have index fund. Right, this experiment has been done for before I was born, actually, a long time ago. Right, let's continue. That's the terms, right? You should remember. Now, if you look at this graph, right, this point, basically that is the level of risk, right? That is the level of risk of one stock measured by standard deviation. So you can call that level as the total risk of a single stock. So that point represents total risk of a single stock. Now the experiment shows us that as we start to diversify, and you have to understand that diversification doesn't add to transaction costs. Why? Because if you have 1 million to invest, right? Whether you want to put all 1 million to, let's say, AIS stock, or you want to split that 1 million into half, right? Put half on AIS, put another half on, let's say, PTT. But since the total investment between option A and option B, right, the value of total investments are the same. Brokerage fee will be about the same because brokerage fee normally calculated from total investment. So what I try to show you here is that when we diversify portfolio, it doesn't add, if we have to invest anyway, whether invest the whole money in one stock or split the money into few stocks, it doesn't add, right, into higher transaction cost. So in finance, we would say that diversification doesn't add to the transaction cost. So as investor diversify, you can see that the total risk of the portfolio start to reduce. Basically, this one tells us that, right, as we start to diversify, we don't have the exposure to certain part of total risk anymore. Right, so as we diversify, right, part of the total risk of a single stock is eliminated. However, as I have all stock in the market in my portfolio, you can see that the total risk of the portfolio is still positive. So that means I can eliminate part of the total risk of single stock, but not all. So in this graph, right, this is the level of total risk of a stock that I can eliminate. And this is the part that I cannot eliminate. And the sum of that two is the total risk of a stock. The part of total risk that can be eliminated through diversification, right, is called unsystematic risk. Another name for unsystematic risk is that this is diversifiable risk. The part that we cannot diversify away, right, we cannot eliminate without cost, is called systematic risk. Another name for it is non-diversifiable risk. So this experiment, right, allow us to have the concept of decomposing total risk of a single stock into two parts. Now, this is important later because remember, when we talk about making investment decision, right? If you can't recall it, let's go back to this example. Remember this example on page 6. This is page 6. Investors have to come up with required rate of return, right? Then compare required rate of return with the expected return that is implied by the stock price and see, right, which one is higher, and use that to make investment decision. Now, the point I made earlier is that company can use required of return, right, to reflect the cost of capital, because that reflects the willingness to invest by investor. And I also claim that required of return consists of two parts: risk-free plus risk premium. And then I told you that the risk premium depends on the investor's perception about the firm's risk or the stock risk. So the risk of the stock will affect required of return or the cost of capital. Now, from the experiment just now, right, we found that, right, the total risk of a stock, right, can be divided into two parts. Right, one part investor can eliminate by themselves through diversification. Another part investor cannot eliminate by themselves. So if investor want to demand return from stock investment, they must only demand compensation for the risks that they cannot eliminate by themselves, right? Any risk that they can eliminate by themselves without cost, right? They shall not demand compensation. So that experiment implies that, right, when investors want to come up with a risk premium measure, investors should use only systematic risk here. Because this is a part of stock risk that investors cannot eliminate without incurring costs. Therefore, they need compensation for it. Anything that they can do it by themselves without cost, they don't demand return. Okay. So from this one, right, we learned that it is the systematic risk that in the end will affect required of return, and therefore the cost of equity capital. So if investor can actually push this graph down, right, push that graph down, right, then they would demand less return, and that will help the firm to reduce the cost of capital. Let's see whether if investors expand their investment to include foreign security, whether we can push this graph down, and whether we can push the efficient frontier toward the upper left hand side. Okay, so that's where I want to go to the next part of this topic, right? We want to see, right, whether investor can get additional, right, benefit by investing in foreign securities. Okay, please allow me to finish one more slide before we go for the break, right? Yeah, that's right, Kun Anya. People normally use these two terms as if they are the same: systematic risk and market risk. That's right. I saw some textbook, they just use the term market risk as if it is systematic risk. But for me, right, I prefer to use the term systematic risk, right? Because if you use market risk, right, to imply systematic risk, you might get confused with what we call the market risk premium. Let me show you CAPM equation. This is CAPM equation. This is the measure of systematic risk of firm I, stock of firm I. And this is the measure of the market risk premium. To me, right, whenever textbook use the term market risk to imply systematic risk, that kind of practice can always bring confusion to students, because they might confuse between the market risk premium as the reflection of the market risk and the beta as systematic risk of a company. So in that way, market risk and systematic risk refer to different things, right? So to me, right, I would like to refer to risk of a company as being systematic risk. I don't use the term market risk that often. Okay. And the reason I put it there is because I just got this. Oops, I got this graph from textbook, and they use that term market risk. Okay. Right. As a Thai investor, if you want to invest in foreign securities, how do you do so? What is the vehicle that allow you to get access to foreign security? There are a few ways. First, if you want to directly purchase foreign securities, you have to open an account with a foreign brokerage company first. And then after you have account with foreign brokerage firms, then you can purchase stock in their market. But nowadays, right, you can actually open account with a Thai brokerage firms. And what they do is that they will open account with foreign brokerage firms. And then you can order your trade through the Thai brokerage firms. And then they will send order to the foreign brokerage firm for you. You can do that also. But if you go through the Thai brokerage firm, right, I found that the brokerage fee is quite high still. The brokerage fee is quite high. So brokerage fee could be the burden, right, to Thai investor who want to trade foreign security directly. In that case, you have to open your account with foreign brokerage firm by yourself. But there might be language barriers, and then you have to transfer money, then you have to get involved with a few things. So that could be difficult. Another way for Thai investors to get access to foreign security is that they can invest through managed funds. That's another option. And this option is also for those investors who don't have knowledge of investing. They can also invest in managed funds. Right? And nowadays, there are so many managed funds in Thailand that has foreign investment objective. So what I try to say is that over the last 10 years, foreign security investment become a lot more easier for Thai investors. So getting access to foreign security is quite simple now for Thai investors because we can also go through managed funds. And there are so many funds that we can choose. But what you have to be careful is just the management fee, right? Try to choose the one that do not charge you too much. If you are US investors, if you are investor from the US, you can even buy foreign securities in your own market, right? US investor can invest in ADR, can invest in stock that is cross-list in US market. And that allows them to get access, right, to foreign security by trading in their own market. But in Thailand, we don't have that. Okay. So what I try to argue on this slide is that getting access to foreign security investment is quite simple nowadays, right, for investor. But whether investor take that opportunity or not, that's another question we have to answer later. Okay. Right. What I want to do next, right, is that I would like to have a break first, right? We go for a short break, then we come back. I will finish everything, right? So let's go for a short break. First, in domestic securities, the source of return, right? The source of return and the source of risk come from two sources. The first is called capital gain loss. The second is from dividend. So these are the two sources of return, right? Which are also the sources of risk, right? In domestic equity investment. Now, when investor invest in foreign security, right? When we purchase, say, IBM stock, we also have to face with the risk of IBM stock price, the risk of whether IBM will pay dividend, right, to shareholders out or not. So these are quite similar to domestic stock, right? But apart from these two sources of risk and return, right, foreign investment also expose investor to additional source of return and also risk from the exchange rate. Since foreign investment imply that investor will have more, right, one more source of return and risk compared to domestic investment. So I have to show you first, right, how expected return and how risk of foreign equity investment can be calculated. Okay, so this part will show you how expected return and risk of foreign security can be calculated, right? The first equation, I'm not sure whether you can recall that first equation is from IFE equation, right? The first equation is called IFE, right? International Feature Effect. Let me show you how that works, okay? And then we will go through an example together, right? For that calculation. Think of the IFE first, right? So we have exchange rate at the end of the period over exchange rate at the beginning of the period equal to 1 plus interest rate in home currency, right? But in our case today, we are talking about stock investment, so that interest rate shall be changed to return, right? Stock return, okay? So let me put it as return better, right? So that it fits with the context today. Now, recall that part, the term on the left-hand side, that part reflects the rate of change in exchange rate, right? That part reflects 1 plus the rate of change in exchange rate. So if I rearrange the equation, right? Because what we want to do is that we want to convert return from foreign investment into home currency form, right? So I do some rearrangement. I would get 1 plus return in home currency equal to 1 plus return in foreign currency multiplied by 1 plus C. Now, you can think of the right-hand side of the equation here as the way to convert, right, return from foreign currency, from foreign investment, right, into the terms of home currency. So that's how I get the first equation. Then you just move number 1 from left to right. You get exactly the same equation there. So this is from IFE concept, okay? Now, what I do next is that from the right-hand side, right, which is the way we convert, right, foreign currency return into home currency. I open the bracket. I open the bracket on the right-hand side. So 1 multiplied by 1, that equal to 1. So minus 1 in the back there, disappear. Then 1 multiplied by C, that equal to C, right? RF, right? R foreign currency multiplied by 1, that is equal to R in foreign currency. And then you have return in foreign currency multiplied by C. So that's the last term. Now, if the return from foreign investment is less than 10%, let's say 6%, so that return on foreign currency would be 0.06. Now, if the change in exchange rate is also less than 10%, let's say 5%, you can see that the product between these two terms, given that each term is less than 10%, right, will be very close to zero, right? Sorry, not close to zero. Oh yeah, that's right, sorry. We'll be close to zero, right? Be close to zero. Therefore, if I just want an approximation, right, I will treat the last term on the right-hand side to be zero. So I get this approximation. And this one is quite clear, right? That, right, when you invest in foreign investment, right, the return that you get from the investment come from two sources, right? The price and dividend of that foreign security plus the return from the exchange rate, right? So the source of income from foreign security come from price and dividend of the foreign investment, and that is reflected, right, in the first term on the right-hand side. And the second source is from the change in exchange rate. Therefore, when I think about risk, right, I can also think about return from foreign investment as consisting of two parts, as if this is a portfolio of two securities, right? So when I look at IBM stock, I can think of IBM stock as a portfolio that consists of two parts, right? The stock in foreign currency and the US dollar. So if I take variance, right, on both sides of this equation, take variance on both sides of that equation. So the left, I get the variance of return, right, on foreign investment after measured into home currency. The right-hand side, right, I treat that as a portfolio of two securities. So I get the variance of the first term, the variance of the stock itself, right? Then I have the variance of the exchange rate plus the covariance between the two. So that's how we calculate risk of a foreign securities. Okay, so let's apply that, right, into examples. This example, an investor, right, has purchased 10,000 AIS stock. This is Thai investment. At the time of the purchase, the stock price was 70 baht. And at the same time, investor also purchased 1,000 IBM stock, right? This is foreign investment. At the time of the purchase, stock price is $60, right? Whereby the exchange rate is 30 baht per dollar. So if you multiply these two, you get purchase price in Thai baht term. Now, the investor hold this stock for, hold this portfolio, right? He hold this portfolio for 3 months. And then he liquidate. So at the liquidation, right, he sold AIS at this price. So if you compare with the original price, you can see that the return on the AIS stock is negative. Furthermore, investor also sell IBM stock, right? Basically, he liquidated the whole portfolio. The selling price of IBM compared to the purchase price also imply that he has a loss, right? Negative return on IBM stock. But that negative return is measured in US dollar. When we convert return into Thai baht, it might turn out to be profit or loss, right? Depending on the exchange rate, right? In month 3. So in month 3, right? Exchange rate is 33 baht. Now, if you compare with the exchange rate when he purchased the stock, you can see that dollar has appreciated by about 10%. So since he hold dollar investment, and afterward dollar appreciates, so that appreciation of the dollar, right, will contribute to profit, right, from exchange rate movement. So from IBM investment, right, we have to take into account both profit loss from the stock and profit loss from the exchange rate. So in the end, the final result from IBM could be positive, right? From the Thai investor perspective, because even though he lost on stock price, but he gained on the exchange rate. Okay, let's calculate, right? What is the portfolio return, right? I have the solution for you in a separate document. Oh, I'm not sure whether I have posted that document or not. I might not have that for you. So you just have to look from the screen, I guess. Sometimes I just forget to post certain document. Do you have this? If not, you can take photo, I guess, right, from the screen. Okay, let me show you bit by bit. Looking for the magnifier. Okay. Oops. Give me a second. I need to get access to a pen. Oh, you have? Oh, good. Just give me a second. I just need to get access. Okay, it's here. Okay, let me explain to you what I do here. So this is for AIS stock, right? So you take price at the end over price at the beginning, right? Then -1, right? That would be the return on the Thai stock. No need to adjust anything because everything is already in Thai baht. Now, for the IBM stock, right? The price at the end is 59. At the beginning is 60. So you calculate the rate of change in price, right? That is negative 1.67%. So this is the return on IBM stock. But this is measured in dollar term. Okay, so now we cannot combine these two together yet, right? Because in the end, we want a portfolio return, right? We can't combine that to return directly because they are still in different currency. So if I want to put them together, I need to convert IBM stock return, right, into Thai baht first. Now, this is the rate of change in exchange rate, right? Positive 10%. So approximately, right, if you just want an approximation, add that two together, right? Because if you go to see the equation I show you, right? Return from foreign investment, right, measured in home currency equal to return on that investment in foreign currency plus rate of change in exchange rate. That would be positive 8.3. Right, 8.33%, right? Okay. right? So that is an approximation. Now, if you want precise calculation, right? If you want precise calculation, you use the first equation, this one. Now, let me show you how we can think about the first equation. Okay, just go down. Now, one way to calculate return on IBM into Thai baht is that, right? I should calculate IBM price in Thai baht term when we purchase, right? That the price of IBM stock when the investor purchase. When he sells, right? The price is 59 at the exchange rate of 33. So that becomes Thai baht price of IBM stock that he can sell. So if I take baht price that he sell, divide by the baht price that he pay for it, right? Then minus 1. That would also be return of the IBM stock measured in Thai baht term, right? Now, if I want you to look at the equation there, right? You can see that I can actually put that fraction in one calculation and take the fraction behind into another calculation and then multiply the two boxes later, I would get the same result, right? And you know what? The first box, that is actually 1 plus return on IBM stock, measured in US dollar. And the second box, that is 1 plus the rate of change in the exchange rate. And that's how we can derive this equation. That is another way to think about the equation, right? So basically just plug in, right? Since I have the return on IBM stock up there, negative 1.67%. Return on US dollar, that is 10%. So put in the equation, this is the precise calculation, right? If you compare with the approximation, it's not bad, right? When the return is not too big, right? Approximation is quite close, right, to the actual result. Now, at this point, right, at this point, I get return on IBM stock measured in Thai baht, this one, from the precise calculation. I also earlier calculate return on AIS stock, which is in Thai baht. Now, since the two returns are in Thai baht already, I can weight them in a portfolio. So the next one I have to do is to calculate the portfolio weight on each stock. For AIS first, right? This is the total investment for AIS stock, right? Basically, you multiply the number of stock purchased with the purchase price, right? We get the value of AIS investment. For IBM, right? For IBM, we buy 1,000, right? At 60. So the value is 60,000 US dollar, right? Now, before we sum up these two numbers, we have to convert IBM value into Thai baht first, using the exchange rate at the time of the purchase, which is 30 baht. So that's how we get the weight down there, right? So that's investment in AIS, IBM. So the total investment is 2.5 million. Then you calculate the weight, and then you apply the return to the weight, right? To get portfolio return. Okay, so that's how you do the calculation. Now, from my experience, right, I found that when students are not finance students, right, they really do not do this kind of calculation that often. The mistake that non-finance students always make when it comes to this kind of calculation is that they tend to calculate the weight wrongly. Now, when I calculate the weight, I use the value of investment at time 0. Right? But some students, I don't know why, they use the value of the investment at the end of the investment period. Use that one to calculate the weight. That is not correct. Okay. Calculate portfolio weight from the value at the beginning, not at the end, right? Because the weight must be determined at the beginning of the investment, right? So that is probably the only warning I have to give you. Right. Next, right? Let's focus on risk. Here, I just focus on return, right? To calculate risk of a foreign investment, right? I have another example for you. But in this example, I don't think I have solution for you, so you have to calculate this together with me. Okay, go to the next question. In this question, right, we assume that the investor is an American investor. Okay, he is considering, right, whether to invest in UK stock or not. And the investment that he is interested in, right, is an index fund, right, that track FTSE 100. This is market index in the UK. Now, from his calculation, right, he expects that the return on this foreign investment, right, UK investment, is going to be 1.23% per month, measured in pound terms, whereby the risk, right, the price risk of this investment is 5.55% per month as well. And this is also measured in pound terms. Of course, if this investor is a UK investor, this would be his risk. But this is American investor. So investing in UK stock, not only he has to face with price risk of the stock, he also have to face with the exchange rate risk. So most likely the risk of the investment from his perspective going to be higher than 5.55%. But how much higher? Let's calculate. To see the risk, right, from this investor's perspective, we need more information. So these are additional information. The investor, right, the investor expects that the pound, right, will appreciate against the dollar by 1% per month. So that means the return from his perspective is about 2.23%, right? Because from his expectation, not only he earned return from the stock price and dividend, he also earned from pound appreciation, right? 2 sources of income, but risk, there will be 2 sources of risk as well. He expects that, right, the standard deviation, right, the standard deviation of the change in exchange rate is 3.5%. So that is the risk associated with the pound exchange rate. However, right, the risk from this investor perspective, right, if I sum up price risk of the stock, 5.5%, plus the risk of the exchange rate movement, that is 3.5% in standard deviation, right? So once I sum these two, right, the risk, the sum of this risk will be 9.05%. Okay, this is my question. Do you think the actual risk that this American investor have to face is higher or lower or exactly equal to 9.05%? Basically, 9.05 come from summing up stock price risk, 5.5%, and exchange rate risk, 3.5%. So you think the actual risk that this investor must face is going to be exactly equal to that calculation, or more than, or less than, and why? Apparently, the risk that he faced, right, is going to be less than 9.05%. The main reason is that the movement of the currency and the movement of stock price might not be perfect. So as long as the two sources of risk, stock price and the exchange rate, are not perfectly correlated, then the actual risk will be less than the sum of the two risks measured in standard deviation. So we need to know the correlation first, right? The co-movement. Apparently, this investor expect that the correlation between stock price change and exchange rate change is 0.58 in correlation term. So most likely, when we calculate the risk, it's going to be less than 9.05%. Okay, let's see whether that is the case. You have to go back to the equation, right? We will use this equation, right? We remember when we calculate risk, we always do it in variance term first, right? You take square root later. So the risk, right, for this investor perspective, oh, okay. I'm thinking about how to explain. Let's say, right? Oops. I will explain, right? Your friend asked me to explain about how the pound appreciation of 1% will increase the return for this investor. I think the best way to explain is to use number. So let's say, right, at time 0, the price of the stock is £1, okay, whereby the exchange rate is $1 per pound. So that means the price in US dollar term is $1, right, per stock. Now, at time t, assume that the stock price, stock price move up by 5%. So if the price move up by 5%, that would be 1.05 pound, right? Exchange rate, let's say, move up pound appreciation by, say, 2%. That's going to be 1.02, right? Now, if you calculate the price of this stock in dollar term, that's going to be 1.05 multiplied by 1.02, which is equal to, I'm not very good at calculation, I need calculator. So that 105 multiplied by 102, that equal to 1.071. Now, if you compare with the original price in dollar term, you can see that the return in dollar term is 7.1%. You can see that, right? Okay, keep that in mind. The return in pound term, that's 5%. Right? The pound has appreciated by 2%. Therefore, for US investor purchasing this stock, not only he get 5% from stock price, he also get 2% from the exchange rate, sum to 7%. UK investor measure everything in pound term, they get 5%. US investor is lucky to get additional return from exchange rate, right? That's how the 1%, right, add up to the stock return. Okay. I hope you get this, right? Okay, that's why I said that one add up to 1.23%. Now we have to calculate the risk, right? So let's put that symbol first. Can you remember this number? I need to delete it. I don't have enough space, right? Just remember that number. Let's say I might have enough. Does the risk, right, of the foreign investment measured in dollar term equal to the risk of the stock price. Remember, when you do this kind of calculation, try to do it in decimal point. Plus the risk from the exchange rate, that is 3.5%. Plus 2 multiplied by the covariance, right, between return on the stock and the exchange rate. But this question didn't give us the covariance, it gave us the correlation. And that should be no problem, right? Because you know how to convert correlation, right, into covariance. Basically, that is the product among standard deviation of each return. Sorry, I start to run out of space. Oops. I try to fit in. Right, and then multiply by the correlation. Okay, after you sum up that 3 terms, right, then you take square root, you find that the risk is less than 9.05%. And that is because the movement of the stock price and exchange rate are not perfectly correlated. Therefore, you get some kind of diversification as well between the two risks. Okay, I have to leave the final calculation to you, right? Okay, let me move on. This question, I want to leave it to you. Right, I have the calculation for you here already. Just another practice, basically, right, on the calculation of risk on foreign investment. Right, that's all calculation we have, right? Next, right, with that kind of calculation behind, right? Now I want to discuss, right? I want to discuss whether investor, right, can actually get diversification benefit from foreign investment. Right, on this slide, right, these are various arguments to support that investors should be able to get benefit from diversification. Don't forget, when they invest in foreign security, they have to face additional risks, right, from exchange rate movement. Right, we do a lot of calculation to show that investing overseas, you have to face, right, with additional risk from the exchange rate. So whether we can in the end, right, get the benefit from going overseas or not, right, is subject to test, right? We have to test. So on this slide, right, these are various arguments, right, to show that investors should get the benefit, right? After I go through this argument, then I want to show you actual result. So I will show you a lot of result, right, to see, right, whether the argument that I want to discuss next is supported by empirical evidence or not, right? Okay, let's go to the argument first. Why people think, right, why economists think that investor will get benefit from international diversification. Okay, and after we finish this argument, we will look at the actual numbers, right? Whether these arguments are supported by actual numbers. First, right, economists argue that different countries normally is in different phase of their economic cycle, right? Some country might be during the recession, but some country might be during the booming period. So if we can invest in stock, right, of these countries, right, we have a chance, right, to diversify because they don't have the same phase, right, of their, they are not at the same phase of economic cycle, right, and therefore this should allow us to get diversification benefit. Furthermore, different countries have different industry mix. With different industry mix, right, the market, right, across countries will not have perfect correlation, right? Some country might be relying on mainly agricultural products. Some country might be relying on product related to, say, mining, right? And different products have their own price cycle. And therefore, if you are heavily relying on different industry, most likely the markets will not be highly correlated. So low correlation imply benefit from diversification. Now, if you come back to the economic cycle, you will also notice that different countries also use different macro policy, right? And different macro policy should cause their economies to be lowly correlated, right? So this is the first argument, right? We should be able to get more benefit from diversification because we should expect stock in the same country to be highly correlated compared to stocks from different countries, right? Due to that reasons, right? If I am investor from developed markets, you can see that developed markets, they tend to be mature markets. Their populations are also mature, right? Not much young people, a lot of old people like in Japan. So if I keep investing in my market, if I am coming from mature economy, you will see that there is not much growth opportunity for me. So if I want to enjoy better growth opportunity, I should expand myself to emerging economy. So therefore, right, this one allowed investor from developed markets, right, to get better growth opportunities. Now, on the other hand, if I am from emerging markets, investing in emerging markets, I get a lot of growth opportunity, but at the same time, markets tend to be quite volatile, right, compared to developed markets. So if I want to invest in a more stable market, right, a more stable market, then I better, right, move some investment to developed market. So this is another benefit that I should get, right, from another point of view. Furthermore, we also know that the market that is more developed, right, the market that is more developed tend to have better transparency. Corporate governance tend to also be of higher standard, right? So investors from emerging markets, right, if they want to to invest, right, in a market that have that kind of property, then they really have to go to developed markets. If you are firms like Nestle, if you're a firm like Nestle, Nestle is such a big firm from Switzerland. So compared to the Swiss economy, Nestle must be quite big, right, compared to the countryside. So if Nestle, right, a big company, right, a sizable company in a small country, want to raise fund, right? The amount of fund that Nestle would like to raise most likely will draw a lot of capital, right, out from the market. So that means in order to attract investors to purchase, say, Nestle stock, Nestle must sell at a cheaper price, right, to induce investor to buy. To reduce the price, that means we have to offer higher return to them. Basically, a big company in a small market, if they want to raise funds, they have to compete, right, heavily with other firms by offering higher expected return for investor, and that will increase cost of capital. So if a big company from a small market can get access, right, to a bigger market to raise funds, that has a potential to reduce the cost of capital. Okay, and that will be from the perspective of firms that want to raise funds. Now, if I want to talk about from the investor perspective, actually I should talk about investor perspective, right? I don't know why Nestle come into my mind, right? I should talk about investor perspective, not the firm perspective. To talk about investor perspective for this point, think about this. Do you know which is the biggest managed fund in Thailand? What is the biggest managed fund in Thailand? The biggest managed fund in Thailand, right, is the Social Security Fund. Social Security Fund. They have assets under management more than 1 trillion baht, right? More than 1 trillion baht. That is the asset under management of the Social Security of Thailand fund. The second biggest managed fund in Thailand belong to government pension fund, right? GPF, government pension fund. The asset under management of the GPF is almost 1 trillion. So these two funds combined almost 2 trillion baht. That's almost equal to the national budget of Thailand, right? Our budget is about 3 trillion, I think, per year. Think about these two funds invest in the Thai stock market. The Thai stock market is quite small, right? Compared to the size of assets under management of these two managed funds. So if they were to invest in the Thai stock only, whenever they want to buy stock, because the market is so small, they tend to drive the price up. So once they drive the price up, they have to buy at a more expensive price. And when they want to sell, due to the size of their fund, when they sell, they inject a lot of supply into the market. So that will drive the price down. So they have to sell at a cheaper price. And this is the cost associated with liquidity of the stock, because the size of their fund is a lot bigger. I should say it's quite big relative to the size of the market. So in this case, right, it would be a lot more better, right, for this fund to be able to invest in foreign securities, because their size will be considered quite small. And therefore, the transaction by this kind of fund will not create price pressure to the market. So that is the example I should explain to you, right, for this bullet. I don't know why Nestle come into my mind when I want to talk about that bullet. Right. If you believe that a war is coming, you must invest in companies, right? That make weapons, right? That make profit from manufacture weapons. But we don't have that kind of fact. I mean, we really have a firm in Thailand that do that, but this kind of industry is not that big in Thailand, right? So sometimes if you want to invest in new industry that might not exist in your country, then foreign investments give you that kind of chance. Right? So there are many reasons why we strongly believe that investors should get benefit from international diversifications. But this is just an argument, right? Whether we get benefit or not, we should test against actual numbers, right? So next, right, I want to show you some actual result, whether these arguments, right, are supported or not. Right. Let's start with this graph. This graph, right, shows us average return and the standard deviation of return of different equity markets during this period. You can see that this area tend to be consist of developed markets. That area tend to consist of emerging markets. So it seems that market in developed economy tend to have lower expected return, but at the same time, lower risk. Market in emerging economy, right, tend to have higher expected return, but also higher risk. That's why I said, if investor from developed market want to enjoy better growth opportunity, they better invest in developed market, emerging markets as well, right? But those from emerging markets, if they would like to reduce the overall risk, right, by still investing in equity, right, investing in developed markets, allow them to enjoy more stable return. So I guess the argument, right, here, right, seem to be supported by the graph just now. Right, next. The next slide show you, right, this is called correlation heat map, right, and this is the scale of the correlation. Right, green colors means highly positive correlation. Right, as the correlation colors start to become more and more red, that means the correlation become lower and lower. Okay. Now each cell represents pairwise correlation. So you can see that actually you can focus on just one half of the whole matrix, because this is correlation matrix. Therefore, the correlation must be symmetric, right? So if you focus on just the lower half, I think that should be enough. And you can see that there are some area where we have a lot of green colors. Quite dark green as well. Some area, the green color, this is also dark green. Sorry. I redraw that. Right, in some area we can see that the green color is not that dark, but still green, like this area. Right, the rest The rest of the area are quite red. So on average first, overall, right, you can see more red than green, right? Overall, you can see more red than green. So that means on average, cross-country correlation seems to be quite low, right? On average, cross-country correlation seems to be quite low, right? And normally it is lower than correlation of stocks within the same country. So stock from different countries, right, tend to have lower correlation than stock from the same country. Okay. However, you can see that if two countries are located in terms of their geographical location, if they're located close to each other, you can see that correlation tend to be higher than countries that are located far from each other. But location can also reflect their economic, right, cooperation. So another observation is that when countries are from the same, right, economic cooperation or the same economic bloc, right, like US and Canada, or in the Euros, like the EU, you can see that correlation tend to be quite high, right? But if countries are not from the same economic bloc, right, the correlation tend to be quite low also. Correlation among developed countries, right, even not from the same bloc, like this whole area, tend to be high compared to correlation between developed and emerging versus emerging, right? So that's the kind of observation we see. So on average, right, we find that the correlation across countries, right, tend to be lower than correlation within the country. Furthermore, right, pairwise correlation seem to have some kind of pattern, right? Countries that are located close to each other, countries that are coming from the same economic bloc, they tend to have high correlation. So high correlation means not much benefit from diversification, right? So this kind of table might also give you some idea, right, where to invest if you want to get a lot of benefit from diversification. Okay, next. The next slide, right, the next slide here. This one, right, this one repeat the experiment that I showed you earlier, right, before we went for the break. Okay, let me show you that slide first. Remember this experiment, right? We look at risk reduction benefit, right, that investor can get from diversification. But in this example, we assume that investor only diversify within a domestic market. Now, the same experiment has been done, right? Assuming that investor can get access to foreign capital, foreign equity markets. And the result is here. This is US study, right? I got it from US study. So this is the original result that we see just now, right? Assuming that investor only diversify in US market. Now, next, right, the researcher, right, assume that US investor can invest in not only US stock market, but also foreign stock market. But they separate foreign investment into two cases. The first case assume that, right, investors have to face exchange rate risk. The second case talking about the same universe of stock, but assume that there is no exchange rate risk. Okay, let's compare domestic versus international first. So let's compare these two cases. you can see that once investor can diversify into international securities, the level of market risk, which in the end, right, will contribute to systematic risk, is lower. Basically, allowing investor to get access to foreign investment, right, and also cause them to be able to reduce systematic risk. So if they can reduce systematic risk, their required rate of return will be lower. That means if firms, right, can get access to this kind of investor, there is a potential for the firm to reduce the cost of capital, because this kind of investor might have lower systematic risk than investor who invest only in their own market. Okay, why that is the case? Okay, to give you some logic, right? Why international investment can allow investor to reduce systematic risk. Let me classify risk, right? Let's say, right? Okay, let's say this is graph. This is stock return. Okay, let's say that. So that volatility is the kind of risk that investors have to face, right, when they invest, right, in this stock. Now that risk, right, can come from the risk that is specific to this particular stock or firm. So we call that firm specific risk. Basically, firm specific risk is the kind of risk that occur from an event that is unique to that firm only. Right? So that event only affects the firm. It doesn't affect other firms. So this is called firm specific risk. But some risk can also be industry specific, meaning that this is an event that affects all firms in the same industry, in the same direction. So I will call this as industry specific risk. Now, risk can also affect all firms in the same market, in the same direction. So if the kind of risks affect all firms in the market, I call that as country-specific risk. But this is the kind of risk that affect the market in a country only. It doesn't affect other countries. So that if that is the case, then the risk is country-specific risk. And the last one would be global risk. This one affects all firms, all countries. Now, when we diversify in home market only, this case, US stock case, you can see that investor can diversify away firm specific risk. If you ask me to give you an example of firm specific risk, I always think about, but this happened long ago, Apple stock. You know, Apple that make iPhone and Mac, right, Macintosh. In the past, right, when Steve Jobs was still around, whenever Steve Jobs has to go to hospital, stock price of Apple dropped because investors feel that he can't be replaced. Nobody can replace Steve Jobs, right, in Apple. So that is the risk, because the firm is reliant on a specific person too much. Therefore, the health of that irreplaceable CEO can affect stock price. And this is unique to that company only. So some firm, right, shareholders have to face the risk of health of the CEO who cannot be replaced. This is firm-specific risk. This kind of risk can be diversified. Investor can diversify this kind of risk at investor level, at shareholders level, simply by purchase stock of a competitor. Why? Because let's say Apple example, if Steve Jobs really passed away, what they're afraid is that Apple might not come up with good, with attractive product anymore. But if Apple cannot come up with attractive product, it doesn't mean that smartphone market will be smaller, right? Smartphone market is probably the same. It's just that Apple will be less competitive without Steve Jobs. Now, when Apple become less competitive, competitor get benefit, right? So if you hold stock of both Samsung and Apple, anything happen to Apple might benefit Samsung to be able to sell more. So you might lose some money from Apple stock, but you gain more from, say, Samsung stock. So this kind of risk apparently can be diversified away at shareholders level. Now, if the risk is industry-wide, basically somebody come up with a new product that will replace smartphone. So now the whole smartphone industry is wiped out. How do we diversify this kind of risk? We have to diversify through cross-country investment. So you have to invest in firms from different industries, right? In that case, even industry-specific risks can be diversified. What we cannot diversify is the kind of risks that affect all stock in the market. That is country-specific. However, if investor, right, can invest in foreign securities, even country-specific risk can be diversified. Because let's say, right, Thai economy face recession. So whichever stock you invest in Thailand, you get a negative hit. So you can't diversify. So that becomes systematic risk. But if you can purchase stock in Vietnam, in China, right, they don't have the same recession as Thailand. And therefore, in that case, even country-specific risk can be diversified, right? That's why investors who can get access to foreign security, they tend to have lower systematic risk because they can treat country risk as being diversifiable and they don't charge risk premium on that, right? And this also have some lesson to the firm. Basically, if firm can sell securities to this kind of investor, the firm can potentially reduce cost of capital, right? Now, the last one. This one assumes that no exchange risk. You can see that once investors diversify their stock in many countries, exchange risk become quite small. You can see between these two curves, one without exchange risk, one with exchange risk, but the difference is not that much. So that means diversifying equity investment across country can also help you to reduce exchange risk, right? Basically, that create natural risk. Natural hedge, right, toward exchange rate. Therefore, right, you can see that additional risk from the exchange rate is not that big, right, from this international diversification. Okay, right. Next, I have a few more. Right, I have a few more. This one, right, show you the efficient frontier. Remember efficient frontier, right? If right? US investor only focus on US stock, right? This is where the risk and return of US investment is located. Now, if the investor expand the portfolio by including international stock, you can see that the efficient frontier is here. So that means investing in foreign security allow US investor to push the efficient frontier toward the upper left-hand side, basically improve the efficient frontier. And this result comes from actual information. And if the investor want to push the frontier even further, now they have to include different classes of assets. For example, bond. When you include bond and stock together, the frontier get pushed even further. Enjoy more benefit from diversification. Now, I repeat this experiment. And this is done by me, myself. I use information during that period. I do this from the perspective of Thai investor. Right, so this is risk and return of the Thai market. Then we have Japanese market, right? GR, German market in Germany, US market, and so on. Singapore market, Australian market. Now, if the Thai investor only invests in Thailand, so most likely he or she will be here. Now, once I assume that they can invest in foreign security, right, and then I construct the efficient frontier using a program, a command, right, in Excel called Excel solver, right, to create this frontier. You can see that it can help Thai investor to improve the efficient frontier and enjoy more benefit. Right, so it seems that the first part of the argument, right, if I go back to the argument page, right, this one seems to be supported, right, by the evidence that I have shown you so far, right? Okay, let's go down. I have a few more things to show you. Right. The following evidence, right, this comes from US study. Basically, economists in the US, right, asked, right, whether for US investor, if they want to enjoy international diversification, right, can they do the following to enjoy international diversification? First, if US investor invest in US-based multinational corporation, can they get international diversification benefit doing this? The idea is because these firms, even though they are based in the US, but a lot of their assets, income, come from overseas. So therefore, if I invest in this stock, I should get access to foreign level of, I should get access to foreign assets, right, by buying the claim, right, of the assets, right, and therefore I should be able to enjoy diversification benefit. But the counter argument is that even though this stock has assets overseas, but they are listed on the US market, and therefore their price behavior might reflect US economy or the US market condition rather than foreign market conditions. So if that is the case, then it might not allow investor to get benefit from diversification, right? Another way for US investor to invest in foreign security is to buy mutual fund, right? That has the objective to invest overseas. One particular interest is focused on closed-end fund, because these are funds that is listed on the exchange. So can we buy closed-end fund listed on the US stock exchange and enjoy diversification benefit. Basically, the researcher wonder whether the price of these funds is mainly driven by the economy of foreign market, or is it driven by the factors in US market? Because if the latter is the case, then there will be not much benefit from diversification, right? From US investor point of view. So let's see the result. I have some to show you. Okay, let's focus on the last 3 rows. Here, right, this is the index of US-based multinational corporation. So this is the beta measured against S&P 500. So S&P 500 reflect the market. So this one is equal to 1 because we run return on S&P against S&P. So beta is equal to 1. Okay. And the last one, right, we run MSCI World Index against S&P, right? You can see that, right, the beta of US multinational corporation is quite highly correlated with US stock market because the beta of this stock is almost 1 measured against US market. So that means the factor that drive the price of this stock tend to be factor related to US market, not world market. But you might argue that, oh, how about if the world and the US are quite similar? So the author of this paper, right, also run US the MSCI World Index against S&P 500 and found that the beta is only 0.7. So the correlation between US market and the world is not that high, right? Compared to the correlation between US multinational corporation, right, against US market. So this result imply that the factor that drives stock price of US multinational corporations tend to be factors related to US market rather than the world market. So whether you can get benefit, right, of international diversification from investing in this stock, right, become questionable. This is for US investor perspective, right? Now the next result, right, this is the correlation between return on closed-end fund, right? These are funds listed on US market. Okay, but this fund has the objective to invest in various countries. Now, when we run the return of the fund against US market index and running the return of the fund against return of foreign market, right? We should expect that the second column should have higher numbers, meaning that investors get exposure to foreign market. But if you look at the result, the beta in the first column is higher, meaning that the return on these closed-end country funds tend to be driven by US market factors, right, rather than foreign market factors. Therefore, question arises, right? How much investor get in terms of international diversification from investing in closed-end fund, right? That raise some question regarding this. Okay, right. Okay, let me go to the last one. Okay, I want to talk about this one and then we finish, right, for today. The result that come next, right, show you the correlation over time. Just now, right, when I show you the correlation heat map, right, this is the correlation, right, measured over a period of time, right? But it doesn't mean that correlation is always the same as time passes by, right? So some researchers try to track, right, the time series behavior of correlation over time, and this is the result. The one in yellow, that is the average correlation among markets in North America, right? Developed American markets. The one in blue, that is the average correlation among developed markets in Asia Pacific, right? Basically anything with DM, that's average correlations among developed markets. You can see that correlation among developed markets tend to be higher than correlation among emerging markets. Right? This would give you some indication, right? If you want benefit from diversification, where you should go. Another thing you should notice is that correlation is not constant. It changes over time. It changes over time. Therefore, right, you can't always expect that correlation is going to be low all the time. It go up and come down, right, if you look at it. Another interesting thing for me is that this period, you can see that during the period of global crisis, correlation tend to pick up. And that across emerging and developed markets. Now, when we have global crisis, as an investor, right, if we have global crisis, would you prefer cross-country correlation to be high or low? Okay, as an investor, during the time of crisis, would you prefer cross-country correlation to be high or low? This is quite important. During the time of crisis, if I invest in two markets, I would like the correlation to be low, right? Right? I would like the correlation to be low because I might lose money in one market, but then I would be able to gain from another, right? So one negative, one positive, that means low correlation. But the thing is that during the time of crisis, you can see from this graph, correlation across country tend to pick up. So that means during the time of crisis, you lose in one market, you also lose in another market. It doesn't come when you want, basically, right? It comes when you don't want. High correlation sometimes comes when you don't want it. But during the booming economy, we prefer correlation to be high so that we gain in all the markets. But if you look at that, when the economy starts to become booming, correlation start to drop. So they disappear when we want them to be there, basically, right? So some researchers look at this point, which is quite interesting. Let me show you the last one, okay, before I finish. Let's look at this, right? This is between US market, right, and market excluding the US. This graph shows you correlation across countries, right? This is between US correlation with world market. Now the x-axis, right, that reflect the return in US market. So if you move toward the right hand side, that is bull market, right? That's market going up. In the US. If you go the left, that is bear market in the US. Now, this is quite interesting because you can see that when the market in the US is a bear market, correlation between US market and the world tend to be higher. That means US investor cannot diversify the risks. because market drop, both US and outside. But in bull market, this is when you want to make profit in all the markets, right? But correlation tend to be lower in bull market, meaning that you might gain from US market, but you probably lose out in another market, low correlation. And this seems to be quite similar, right? Whichever country you want to look at. So even though on average, correlation is low across countries, but it's not constant. Sometimes it is high, sometimes it is low. And what you have to be careful is that during the time of crisis, correlation tend to be higher. So if you want to diversify during crisis, you have to diversify not only across countries, but probably across asset classes as well. Okay, that's what we learned from this kind of result. I'm so sorry, I exceed the time, right, by about 10 minutes. I think I stop here, right? I have one more result to talk, but I can wait until next week. Okay, so let me stop sharing first. Next week, right, I will use these results, right, as a basis to discuss about how the cost of capital should be calculated. Okay, we use this result as the background, right, to discuss about cost of capital calculation, especially the cost of equity capital, right? Okay, I think I better stop here. Oh, by the way, this Friday, I have to give you another homework, right? So please check the blackboard, right, on Friday. There'll be second last homework, right, this time. Okay. Any question you want to ask first before I leave the class? Okay, if there's no question, then I see you next week. Next week, I will talk about the final exam as well, right? About the setup of the exam, okay? So don't forget to come next week. Right. Okay, I see you again next week. Have a good day, right? Thank you.